A golden lie. Over the past 3 weeks, gold has perked up, rocking nearly $100 per ounce. But is gold ready for its next leg higher? Or is it another letdown? Like it or not, gold has been in a downward trend for over a year. Lower highs have come with lower lows, leading to 12 months of falling prices. Right now, the 1700 to 1750 per ounce level remains a key short-term area of support for gold. You'll see that after its recent rise, prices are right smack at the resistance trend line. That's the chart you're looking at right now. Focus on those two purple horizontal lines. But the trend is your friend in the long term, but you have to be aware of the short-term trends. But to truly understand if gold is ready to go higher, one must look deeper than support and resistance on a couple of charts. Transitory inflation and gold. As I have mentioned many times, we are in an era of quantum economics with ultra-low interest rates and a strong US dollar. Blame it on the global supply chain, central bankers, or politicians, inflation has been running hot. Regardless of whether this is transient or here to stay, it is making investors and the US Federal Reserve uncomfortable. In my book, The Rise of America, I discussed a phrase I coined called crossflation, and that is exactly what has been playing out. So what does the US Fed really think? I think if you've got a few glasses of vino into Jerome Powell off camera, he would admit that they have underestimated the supply chain issues, which are a key root in today's inflationary pressures. I don't have a crystal ball for inflation, neither does the Fed. But what I do know is that gold and commodities have the potential to perform very well in an inflationary environment. It's what's happened in the past, and I think it's what's going to happen in the future. Let's look into why this is the case. The CPI, which stands for the Consumer Price Index, which many use as a barometer for inflation, continues to soar. But you have to focus on what is in that CPI. The Fed's preferred measure of core personal consumption expenditures, known as PCE, while a lower absolute number, it also shows rising costs across the economy. Rising prices combined with near zero interest rates create a negative yield in real terms. Today, real yields are negative 1.14%, within striking distance of all-time lows. That's the chart you're looking at, which is the US real 10-year bond return. We're touching near all-time lows. Real yields and gold, this is where you really have to pay attention. There's a simple yet very powerful relationship between real bond yields and gold. Gold has a storage cost. Bonds have virtually no holding costs. So if both are safe, you'd pick the one with the free storage cost if you're a big fund or sovereign wealth fund or a big pension fund. That's just how it's been. However, when bond yields are negative, like they are today, those bonds now have a storage cost, which is higher than gold storage cost. You can see that in the chart that we're presenting right now, that the powerful relationship that is exemplified. If real yields stay low or go lower, there's a strong supporting case for gold. Gold stocks are up, but well below their 52-week highs. The prices for gold equities are rising. Miner-focused ETFs are up double digits the past month, while the number of companies trading close to their 52-week low has plummeted. This is a simple sentiment indicator that I like to keep on my radar. That's the chart we're looking at right now, the precious metal companies trading range analysis. So I got rid of all the, nano cap and micro caps that trade on appointment. So this index is made up of all of the companies that are bigger than $100 million market cap and have at least $5 million or more in cash. The red line shows within 10% of their 52-week low, and the green line shows within 10% of their 52-week highs. You can see where the market's at right now. Look, mining is very tough business. Being able to take money off the table and recycle it at lower price swings, the risk reward is in the investor's favor. Many gurus mocked me for selling heavily across our portfolio when gold breached $2,000 per ounce last year. That's fine. I don't work for anyone other than myself and my subscribers. Taking profits last year in the gold market has allowed subscribers and myself to be positioned the way alligators want to be positioned, to redeploy those gains and cash at prices well below than we were selling. For example, my favorite gold stock today has more gold in reserves and resources, has a better production profile than it did last fall, and yet gold prices are down over 40% from when we sold last year. The current gold market is exactly the gold market for alligators. It's literally the golden alligator market. It's the type of market where if you know what you're doing, remember, math matters, understanding mining matters, avoid the noise, the potential for big scores in de-risked companies is very probable. Remember, you don't need to go to crazy risk to get big returns. The chart you're looking at right now shows the cumulative free cash flow generation for North American precious metal companies. You can see that for a decade straight, the industry was a black hole for capital. But that things changed. Now, the sector has strung together multiple massive quarters and rebolstered battered balance sheets. This is the best performing the balance sheets of these mining companies have been in over 25 years. Miners today are laser focused on efficiency and cost control. Technology today allows for optimized mine plans and ore sorting, which lowers production costs per ounce. The average all-in sustaining cost per ounce produced for senior and mid-cap gold producers is roughly $1,100 per ounce. Today's gold price is a little over $1,850 per ounce, leaving a little over $750 per ounce in potential free cash flow. These are incredibly healthy margins for gold producers. As I mentioned, subscribers and I have begun to gobble up back positions we took profits on last year in the gold space. I still see tremendous upside for all our core holdings. If you feel like you missed out on the big gold bounce of 2020 and you want to give your portfolio an edge in 2022, I think I might be the right guy for you. Stay safe. Subscribe to the KRO, which is a Katusa Resource Opportunities, to find out exactly what prices I'm buying at and what price I sell at before the trade occurs. And you get to sell before I do. If you want to give your portfolio an edge, consider becoming a member and giving it a try for yourself.